Welcome back to the Deep Dive. Today, we are digging into the January 13th, 2026 earnings release for Concrete Pumping Holdings.
Yep, we're covering their Q4 and full year 2025 results. And our mission, as always, is to cut through the noise.
We're looking past the presentation script, past the analyst chatter to find the signals that really matter for you.
And with this call, those signals give us a really unfiltered look at the health of the U.S. construction market. And maybe more importantly, a map of the company's defensive playbook for the year ahead.
And what a defensive playbook it is. I mean, if you just glanced at the stock chart the day after this release, you got the main takeaway right there.
Oh, yeah, that next day sell-off.
Exactly. This call was so much less about celebrating a Q4 beat and way more about setting this deeply cautious, almost guarded tone for 2026. Investors heard it loud and clear.
Okay, so let's start with that Q4 snapshot. Because on the surface, the company delivered a headline beat.
Right.
Revenue came in at $108.8 million, which beat the street's estimate by a solid $6 million. And diluted GAAP EPS was right in line at 9 cents.
Okay, so hold on. If they beat estimates, why the sell-off? That's the first thing I'm thinking.
That's the critical nuance. That revenue figure, the $108.8 million, still represents a slight year-over-year decline. It's down 2.4%.
Ah, so the pie is shrinking. They did better than the low expectations, but the overall volume of work is softening.
Precisely. The top-line pressure is undeniable. But what really stood out to me was their defense on the profitability side.
Mm-hmm.
I mean, despite those shrinking volumes, they actually increased their gross margin by 100 basis points year over year. It hit 39.8%.
So just for everyone listening, 100 basis points is a full percentage point. They increased their margin by 1% during a slowdown. How did they manage that?
It really speaks to discipline. I mean, serious discipline in two key areas, pricing and cost control. They're successfully passing inflation through, especially in those bigger, more technically complex jobs where their equipment is, indispensable.
And looking at the full year, does that trend hold up?
It does, and it confirms this isn't just a quarterly blip. For the full fiscal year 2025, revenue was $392.9 million. That's a 7.7% drop from the prior year.
Wow, okay. A nearly 8% drop is significant.
It is. But again, credit where it's due, they held those unit economics tight. Full year adjusted EBITDA came in at $97.0 million. And they kept the adjusted EBITDA margin at 28.2% in Q4.
So they're controlling costs meticulously, even as the market volume is pulling back on them.
They absolutely are. And that impressive discipline leads us straight into the forward look, which is what really tanked the stock. We have to talk about the fiscal year 2026 guidance.
Right. This is where we shift from what happened to what's coming. So let's unpack it. Management gave their formal guidance. What were the numbers?
They're expecting FY 2026 revenue between $390 and $410 million. And adjusted EBITDA between $90 and $100 million.
Okay, but it's the assumption behind those numbers that matters, right?
That is the crucial part.
Yeah.
This is the line that caused the stock to dip. Management explicitly, and I mean they went out of their way to say it, that this guidance assumes, and I'm quoting here, no meaningful recovery in U.S. construction markets during fiscal year 2026.
No meaningful recovery. That framing tells you everything. They're not relying on hope. They're not waiting for a Fed pivot to save them.
Not at all. They're taking a flat defensive baseline and building their entire plan around it. If you look at the midpoint of that guidance, the implied top-line growth is maybe, 2%?
Low single digits, yeah.
But here's the kicker. They confirm they expect actual volume to be largely flat year over year.
So that tiny bit of revenue growth is coming from where then? Price increases?
Almost entirely. It's coming from pricing improvements on those big, already secured projects. So they're fighting to hold price and margin while absorbing a static market.
Which means lower fleet utilization, more of their expensive gears just sitting idle.
That's the challenge. And it's that cautious outlook that's driving their other strategic decisions. Specifically, the most fascinating part of the call for me, their capital expenditures.
You're talking about that $22 million CapEx pull forward.
Exactly.
At first glance, that seems counterintuitive. Why spend more and sacrifice cash flow when you're already forecasting flat volumes?
Because it's a proactive hedge. It's a brilliant defensive move that's tied entirely to future regulations. They're accelerating $22 million of CapEx from fiscal 27 into fiscal 26.
And this is all about preparing for what?
The stricter 2027 on-tax emissions standards for heavy-duty equipment.
Okay, so break that down for us. Why is that specific 2027 date such a threat that they'd spend $22 million early just to avoid it?
They are essentially learning from some very painful history. Management talked about the last major engine emissions change, which was between 2008 and 2013. And that period was just a mess. It was years of operational disruption because the first generation compliant equipment was, frankly, terrible. It was unreliable. It led to massive maintenance costs, huge downtime.
So they're making a bet now, a massive long-term bet that getting the replacement equipment before that deadline hits is worth the short-term financial pain.
Precisely. They are de-risking their operations. They're trying to avoid two things. First, the guaranteed price spike on trucks when everyone is forced to replace their fleets at the same time.
And second,
and maybe more important, they get to secure proven reliable equipment now instead of being stuck with first-gen systems in 2027 that could break down and sideline their business.
and it's a timing shift, not a structural increase in their total CapEx plan, which is a key point. And they can afford it, right? Their balance sheet can handle this.
Oh yeah, their balance sheet is solid enough to support it.
Yeah.
They have about $54.4 million in total liquidity. Their net leverage is at 3.9x, which is comfortable for this kind of business.
So they have the flexibility.
A luxury that a lot of smaller, more leveraged regional players just don't have. It shows how being well capitalized can be a huge competitive advantage when regulations shake up an entire industry.
Okay, and beyond managing the fleet, they also touched on expansion, right? Something about Ireland.
Yeah, a modest acquisition.
Yeah.
They bought a company called CGA Concrete Pumping in the Republic of Ireland. Its small adds about $2 million in revenue and $500,000 in EBITDA.
So just a small tuck-in?
Well, they were clear it's not a one-off. They see it as a beachhead, a new geographical base to grow from, especially by using the common travel area between the UK and Ireland for moving equipment and labor.
Interesting. Okay, let's break down where the actual demand is coming from in their core segments. Let's start with the bright spots. Ecopan, their waste management business.
Ecopan just continues to be a standout. It's a great organic growth story. Revenue is up 8% organically in Q4.
And for 2026.
They expect it to get back to high single-digit, maybe even low double-digit growth. It's all driven by density and pricing as they expand into new cities. Their service is basically non-discretionary on a job site.
Right. Okay, what's the other anchor holding things up?
Infrastructure, a clear bright spot. It's about 24% of their U.S. pumping revenue, and it's pretty insulated from interest rates. We're talking about sustained federal and state funding for roads, bridges, big public projects.
And now for the big one, the commercial market. It's almost half their revenue at 47%. This is where that cautious outlook really comes into play, right?
It's a tale of two cities here. This segment is completely bimodal. On the strong side, you have heavy, complex projects. Think massive data centers, semiconductor fabs, huge distribution centers.
Projects driven by long-term trends like AI and supply chain shifts, not short-term interest rates.
Exactly. These are multi-billion-dollar, multi-year projects that favor a company like them. But the other side of that commercial bucket is really weak.
What's getting hit?
Light commercial, planned office buildings, general manufacturing starts. All of it is either shelved or significantly delayed. The speculative office building market is basically frozen.
Got it. And that leaves residential about 29% of their revenue. What's the story there?
Well, you can probably guess. Residential demand softened late in the year, all due to affordability and high mortgage rates. They're cautiously optimistic about a slow path back, but they're guiding for the residential revenue to be roughly flat in 2026.
So no housing boom is going to come and save the day.
Not in their plan, no. The whole thesis for 26 is flat volumes, offset by some pricing gains in heavy commercial and infrastructure, with Ecopan carrying the growth torch. It's a game of defense.
And that defense is all about cash, right?
It's all about cash generation. They are targeting at least $40 million in free cash flow for 2026. And here's the key. That number excludes the $22 million in accelerated CapEx.
Wow. Okay, so they can absorb that big strategic investment and still generate a ton of operational cash.
It confirms the stability of the platform. And with that cash, they're returning some to shareholders. They talked about their buyback program.
Or the numbers there.
They bought back about 274,000 shares in Q4 at around $6.73 per share. And they still have $18.5 million left in the authorization. It signals they think the stock is cheap.
So tying it all together, what we're seeing is management just controlling what they can control.
That's it. Pricing, costs, asset planning. They're explicitly discounting any kind of macro tailwind for 2026. It's a pure execution story.
And the market is clearly sensitive to that no meaningful recovery baseline.
Absolutely. The sensitivity is high. Investors are worried about the macro, even though the company itself is executing really well.
Okay, that brings us to our final segment. This is not financial advice. This is where we pitch an outrageous but plausible trade idea based on our discussion.
And let's be crystal clear. This is purely for analysis and entertainment. This is not investment advice.
Right. So let's talk about a long-term regulatory arbitrage play driven entirely by that $22 million CapEx pull forward.
They're turning regulatory compliance into a competitive weapon.
Essentially, yes. The setup is that they're sacrificing cash flow in 26 to build a competitive moat and avoid an operational disaster in 2027. So here's the trade pitch.
Okay, let's hear it.
You go longer dated call options, think late 2027 or 2028 maturity on concrete pumping holdings. And at the same time, you look to short a smaller regional competitor, especially one with an old fleet and less financial flexibility.
That is aggressive. Okay, walk us through the rationale there. What's the actual bet you're making?
You are betting that the proactive $22 million investment becomes a material competitive advantage. You're betting that when 2027 hits, the supply of compliant equipment will be tight, prices for new trucks will spike, and reactive competitors will get crushed.
Crushed by higher financing costs, delayed fleet replacements.
And significant operational downtime from unreliable first-gen engines that 2008 rerun management is so afraid of.
So the long option on concrete pumping holdings is a bet on their superior fleet availability, that they'll be able to swoop in and capture market share from distressed competitors.
Exactly. You're betting on their prudence paying off with material market share gains 2 years from now. It's a bet on operational uptime being the ultimate competitive advantage.
A fascinating idea. Well, to wrap this up, this earnings call really gave us a clear playbook for prudence and survival. They're prioritizing long-term reliability over short-term cheer.
Right. The key takeaway for you listening is that in this late cycle environment, operational discipline, cash management, and that long-term strategic asset planning are just so much more critical than a simple quarterly beat.
They're playing chess, while a lot of others are still playing checkers.
Which leaves us with one final provocative thought for you to think about. Given how aggressively management is moving on this, are we all underestimating just how severe the 2027 ACAMEX emissions compliance curve will be for the entire heavy equipment industry?
What other late-cycle service providers who rely on truck fleets are going to suffer from this expensive and potentially unreliable fleet refresh?
Something to think about. That's all the time we have for this deep dive.
We look forward to diving into your next stack of sources soon.